are traded in the financial market. So with that, we'll get into some of what this option, like contract the person who's buying the option, right? And there is an option. Option seller. As well as an option buyer. So there are two buyer option or the beauty of the option to participate in the trade and not the obligation to participate in the trade. As right. So this right means that if this right means that he's going to exercise the option only if the option is beneficial to exercise for him. Otherwise, he will leave the option unexercised. Right?
Your voice is not clear. Your voice is not
My
clear.
voice. Oh.
Mayank, I think, can you join from your mobile?
Yeah, I'm trying to join. Let me join from my mobile. Just one second.
Yeah.
The room where there's like where there's a router right next to it. And it will be better.
You are not audible.
Okay, I'm trying with my phone. Just a second.
Okay.
Hello. Yeah. Am I audible now? Hello. Yeah. Am I audible now?
Yeah, right now you are audible.
Okay. Cool. So I am sharing these slides. Let me know once you can see these slides. Can you see these slides? Can you all see these slides as well?
No, sir, no.
Okay. Let me see how to share these slides using phone. Otherwise, I can email these slides and someone can share it on my behalf. That would be great.
Yeah, you can mail it to me.
Yeah. So I have already emailed to you yesterday night.
Okay.
The latest one.
On Rediff?
On Reddit.
ये पानी से ठंड लग रही है अब इसे
Hello.
Yeah. Hello.
How? हाँ हाँ आज से स्टार्ट होनी थी, कल बच्चों को मैंने बोला भी था।
Hello. Can you? Yeah. Can you hear me now?
yes sir yes sir you're
Okay.
audible now
Cool. Cool. Thanks. So yeah. So I'm on slide 2, which is derivatives. So let me recover it since I don't know how audible I was. So so in general, as I described, like derivative is a concept. Option is a broad, option is an instrument that falls into a broad classes of tradable instruments that is called derivatives. And derivative is nothing but a tradable asset whose payout, or the payout, by payout I mean what you get paid at the expiration or the final expiry of the derivative, depends on any underlying asset whose price is commonly traded in the market. So you can have, like in common, you can have derivative on oil, you can have derivative on bitcoin, you can have derivative on almost anything that where you can have market participants agreeing on the price of the underlying asset or underlying instrument. And options and like two most common types of derivatives are futures and options. Options is one of the most common types of is more common and a little more complex derivative than a future, because option gives you a certain section of the payout which is not which where there is, so as the name suggests, there's optionality in there. It is a right, not an obligation, to kind of exercise the option. So with that, can we move on to slide 3, please? Yeah. So let's discuss what the option what an option is in general, right? So option is, as the name suggests, right, it's like there are two counterparties involved. One is the option buyer, we call it, and other is which is also called option holder, and then the other counterparty is option seller, or which is called option writer. So for every option contract, there is a buyer and a seller, right? And the complexity of the option, or the beauty of the option, really is that it gives the investor or the option buyer the right to participate in a trade, but not the obligation. So if, let me put it this way, that the person who owns the option will exercise the option only if it is profitable for him to exercise the option. Otherwise, he will leave the option unexercised, right? So it's a asymmetric payout, where it's like an insurance premium. Think of it like that, where the person who is buying the insurance will exercise or use the insurance only if it is profitable for him, or it is in the benefit of him to exercise the insurance. Otherwise, he will not use the option insurance. So then why would anyone, why would everyone not buy the option, and why do the sellers of the option exist? So like in insurance, it's the similar thing is in option, true in options, that for, like, in order to buy this option, which gives you a potential profit or a potential outcome at the future expiration date of the option expiry, you have to pay a premium to get into this option, and the premium is dependent on various conditions or what the trade in the option represents. But so the option writer is earns or pockets that premium. Like if you go and buy an insurance, you pay a premium of buying or getting into that option insurance policy, and whether you end up exercising or not exercising, using that insurance or not using that insurance, you have to pay that premium. So the similar thing is true with options. So when you go and buy the options in the market, you are spending a certain amount of money to enter into the option transaction. Now, even if the option expires worthless, or at the final expiry date of the option, you don't end up exercising the option. You still have to you still have paid the premium that the option writer or the option seller has earned, right? So it's like the concept in theory is very similar to what is done in any general insurance policy, right? So let's move on to the next slide, please. So with that, coming on to the next slide is like, let's say, okay. So with this, like, why trade options? Like it's like, again, you have to ask yourself, trading options is same as like buying insurances. So why do people buy insurance? So one of the most common reasons people want to buy insurance is to hedge their risk, right? So let's take a common examples of who are the people who are like, who are the major broad institutions who will buy and buy these options, right? So for example, if you've got an airline company, right? So airline companies, one of the major costs for an airline company is the price of the oil, right? So if the price, that's one of the major cost items for an airline company. So if suppose I'm starting to I'm deciding my future directions or the future cash flows or projections of my airline business, and because the price of the oil can fluctuate quite a lot, I don't know the cost of running, or like my operational cost of running the airline, because it's heavily linked to the future price of the oil, right? So in this case, why would so what do airline companies would want to do is, they would like to like to fix the price of the option at of the oil at up at a at a level which is decided as of today itself. So let's say the oil is trading at $50 per barrel. Then they will like to say that, okay, I'm going to buy the oil. No, like I want to have the ability at the right to buy the oil at $50 in 2 years from now, and I'm willing to spend a certain amount of premium to get this option, right? And if the oil is cheaper than that, so since this is a right, not an obligation. So if the oil is cheaper than that, if the oil is trading at $30 per barrel, I will leave this option unexercised, and I will directly go and buy the oil from the market. If the oil goes and trades at $70 per barrel, I will like to then exercise this option, and whoever has sold me this option has the right, has the obligation to deliver me oil at $50 per barrel. So through this transaction, what I've now done is I've spent, let's say, a certain amount of premium on that. Let's say call it $5 premium on that. But in $5, spending the $5 premium, I have ensured that my price, the future cost of this oil, in 2 years' time will not exceed $50, no matter where the current oil, like future oil price is trading at that particular point of time. Right. So this is a common example for trading commodity options. Like another example is like foreign exchange options. So that's pretty common with like companies or individuals who have got like asymmetry, like whose cost is in one currency. Let's say Indian business who's exporting products to to UK. So the cost of the company is in INR. The revenue of the company will be in pounds. Now, in this case, depending on where the pound to INR conversion rate is in future, the profits of the company can fluctuate quite a lot. So is in other words, if the revenue is in pounds, the owner or the owner of the company would want the INR not to strengthen too much against pound. By strengthening means that the pound not to deteriorate against INR. So he would want INR to remain as low as possible when it comes to against pound, because he's earning a revenue in pounds, and the higher the pound to INR conversion is, the more INR he will get for the same amount of revenue he generates in pounds. So in order to he's constantly running the risk that, okay, my pound to INR conversion rate can move against me, and my revenue in INR terms, because all my cost is in INR. I live in India, so everything is my whole world depends on where the INR, like how many INR am I getting, or Indian rupee am I getting. So in this case, what he wants to do is he wants to say that, okay, I don't really want to care about. I'm ready to spend a little bit of a premium right now, but I don't really care about what the conversion rate is in future. I want to lock that conversion rate right now. And in order to lock that, and it's like asymmetric lock. So he's trying to get a right, but he doesn't have. So if the conversion rate moves in his favor, then he will not use that option, like insurance or option, to exercise it. Otherwise, he will use that option and to exercise it and to get it at a predefined level, right? So another very common example is, and this is a big market in US, is that like United States, people always get, like when they issue mortgage loans, they're always fixed rate loans. But in order to convert fixed rate to floating rate, you enter into an option trade, saying that, okay, I will convert my fixed rate loan into a floating rate loan. If my floating rate is greater than a certain fixed rate, then I will pay the fixed rate. Otherwise, I will pay the floating rate. So this is called interest rate options. And the most like the last and but one of the most highly traded options these days are equity options, where it is just like buying and selling on a certain stock price. And like in terms of, you can think of in terms of hedging it. So you own a stock of a certain company, and you don't want to sell the all stock, but you're still worried that the price of the stock may go down in near future. So all you do is you try to buy an option to say that I should be able to sell, I should have a right to sell this option at a pre-decided level. And of course, there are no free lunches, so that option doesn't come free of cost. You are willing to spend a premium, a little bit of money upfront, to have that optionality and limit your potential downside by a lot, by spending a small amount of premium upfront, right? So these are common use cases of options of why one would use options for hedging, which is like pure risk management purpose. Other people also use it for speculation, right? So options gives you one of the most primary things options gives you is leverage. And by leverage is a simple term, right? Like if stock index goes up or the stock goes up by 1%, how do I stand to gain 10% from it? Right? So that is also you can buy options, or you can buy or sell options to get into those kind of payouts. Of course, leverage comes both ways. So leverage is not something that you have only upside leverage, you also have a downside leverage. So people should be careful when they're trading options, is that like your upside is large, so is your downside. So in that case, if the stock goes down by 1%, your option price can go down by 10% as well. So it comes both ways as well. So this is two common use cases of why people trade options. One is for hedging, other is for speculation or leverage kind of. So with that, let's move on to the next slide, please. So yeah, so now let's discuss the two most common types of options that are traded in the market. It's called call option and a put option, right? So as the name suggests, the call option gives the option buyer the right to buy within a pre-specified time period at a pre-specified price. And let's get into the terminology. The pre-specified time period, it's commonly known as the expiration date of the option. And again, I try to draw the resemblance with any insurance that you buy. The insurance has an expiry date attached to it. That the insurance is only valid up till a certain amount of time. And similarly, the option is valid up till a certain expiration date of the option. And if you want to buy a longer dated options, there is the market, like in the market, options are trading with different expiration dates. The longer dated options will come at a higher price, a higher premium than the shorter dated options, right? The second term is called the strike of the option. The strike of the option is nothing but what is the level at which you are fixing the price of the underlying asset commodity to be bought. So in the original example that I gave of oil trading at $50 per barrel, the strike of the option was $50 because I am entering into a transaction where no matter, you're saying that no matter where the price of the oil is, I am going to buy the oil at this $50 per barrel price, per barrel price at a future point of time. So that's called the strike of the option, right? So these are so any option is so. And if you go and look into the NEC website or any particular option, like any broker on this, so option, like there will be, you will see a lot of options listed with different expiration dates and different strikes. So our option is unique, only given an expiration date and a strike of the option. So you will have different options trading at different expiration dates, and you will have different options trading at different strikes, right? So this like given an expiration date and strike makes the option or a unique instrument to trade, and you will have multiple of such trading at that particular time, right? So and then what? So the next term is that, yeah, in order to buy this option or sell this option, the you will need to spend the premium upfront. The premium is nothing but the price at which the option is trading. Like basically that's the cost of buying the option. And the cost fluctuates depending on various conditions, some of which we will go down into detail in the later slides. But think of it like in general any other, like if you go and try to buy an insurance, your health insurance, your policy insurance rate depends on various factors like your age, your pre-existing health conditions, and so on and so forth. Similarly, the option and the amount of, for example, uh, the amount of insurance premium you will spend will be determined by all these factors combined, right? But in terminology, when we say, people say option premium, it is nothing but the price at which the option is trading, or the price you are willing to pay into or enter into a transaction which gives you the optionality optionality, which is the right but not the obligation to trade the options, right? So in other words, there is no, so like it's very clear that if you're buying the option, you have the right but not the obligation. So you will only exercise the option only if it is favorable for you to do so. So the amount of money you can lose as an option buyer is just the premium itself, or the purchase price, or the premium itself. So that's what makes option, like that's what makes it easy for people to spend this premium as a buyer of the option, because they know that they are not going to lose more than this premium spent. While as an option seller, I will get into more detail into later slides, you can lose a lot more. But again, you can lose a lot more, but what usually happens in the market is that option buyers, so there's always like the amount you will lose and the probability of losing that amount, right? So even though the outcome of option seller can be a lot worse, in most cases option sellers would not incur that outcome. So the probability of that event happening is going to be small. Hence, there is a market, both-sided market. There are option buyers, there are option sellers, and people disagree on. So people agree on the payout of the option, but disagree on what the probability of the outcome is, and that's why any transaction happens, because two people who agree on the value of the pre of the payout, but disagree on the price, or the probability of the payout happening, right? So 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 the call option is nothing but an option to exercise if at a certain price, or buy that asset price at a particular strike price. So if the on the expiration date, if the commodity or the underlying asset is trading at a price which is less than the strike of the option, then of course any rational investor will not exercise that option. He will, because like, suppose, in like, going back to my original example, suppose the oil, you have gotten or bought an oil option at $50 per barrel, and the oil actually in 2 years time is trading at $30 per barrel. Then you will not exercise this option to buy oil at $50 per barrel. You will directly go and buy oil at $30 per barrel in the market. However, if the option is trading at the oil is trading at $70 per barrel, then you will say that, okay, I want to exercise this option now, because I will go and exercise this option, which gives me the right to buy the oil at $50 per barrel instead of buying it at $70 per barrel, right? So this is the payout of a call option. With that, can we move on to the next slide, please? So in the next slide, I have like what does buying of the call option really entail. So I'll give, like, this as like, we'll deal with the example, right? So let's say your stock options. So stock options, when you say buy, usually under, like, it denotes a certain lot size. The lot size is amount of underlying shares it is holding. So in common example these days, Nifty has a lot size of, I think, 75. So if you buy one Nifty option, that's like buying 75 lots of underlying Nifty or Bank Nifty stock or index in this case, right? So let's say in this example we have a stock whose stock options which have underneath as 100 units of underlying stock, right? So now a trader goes and buys this call option, right? And the trader goes and buys this call option with a strike price, as I discussed, is 25. The strike price is the price at which he is willing to exercise this option, right? And he ends up paying $150 for 100 shares of the stock. So one share is trading at $25, and he ends up paying have sorry one share, one option has a strike of $25. So he can exercise 100, he can get into 100 shares of the underlying stock, and he spends $150 on paying on the premium of this option. Hello, am I audible now? Can anyone hear me?
Yes, sir.
Okay, cool. So I can't see these slides in front of me. Can everyone else see these slides?
No, sir.
मयंक जी अभी रॉकी जी कर रहे हैं.
अच्छा अच्छा ठीक है.
Yeah, he will start.
हाँ, बता दीजिएगा जब भी हो जाए.
Hi, good morning, everyone. Yeah, till then the presentation will be start. Then I wish to talk to all of you. Then I think you all of getting a good benefit about this different type of STTP, where we invited four guests from the industry and four from the academia. And today's, if I talk about the today's schedule, the after Mr. Mayank Sachan, he is a vice president in Goldman Sachs, New York. Then on the second half from 1:15 to 3:15, we have another session. Professor Dr. Shailendra Dubey, he belongs to Ministry of External Affairs and work in a various institutions in Delhi NCR. So his topic on methodology and case study of supply chain management, and he will take the case study of Mumbai Dabbawala. It's a very famous because if we talk about the supply chain management, so Mumbai Dabbawala is a one of the live example, or we can say it is a father of the supply chain management case study. From last 50 years, the Mumbai Dabbawala, they are presenting their performance, errorless performance in a Mumbai, and which they are called by the that Maharani Elizabeth on the Buckingham Palace also. And second, he will take example of the GLI Amazon during COVID-19, how they maintain their supply chain management. So again, I need to just want your views about this running short-term training program AICT approved. So shall everyone is most welcome. Anyone can be share their views till then. I wish to welcome everyone. So anyone who wish to share their views about this uh, running AICT sponsored STTP. So shall I take a name, or anyone can open a mic and video so that share their views on it? Everyone is welcome. Anyone can share their views. Just open the mic. I am inviting a world best academician. Those are today present in this AICT sponsored STTP. Dr. Jayashankar Prasad, Pradeep Pandey ji, Shailja Nimagada, Sarita Rathi, Shwet Ketu. Anyone can be share their views. Shwet,
Hello, sir.
good young champion. How are you?
I'm fine,
That's
sir.
we love to listen you.
Yeah, it's a very interesting and very healthy conversation that we have previously STTP, and now the things are changed. Why we are mapping the 21st century to the current scenario in the business paradigm? We are seeing the the wings of businesses, how we can establish and how we can plan a review or a study, or we can form a that you are telling about. The next session will be a dabba wala, that uh, supply chain management. That is the essential part of any business, I guess. So we have lots of viewpoint about the various professors and the industry peoples, so we can take a efficient or effective strategies to deal with. So it was so nice to listen all the professors and industry peoples.
Thank you, Shwet, for your valuable views. Anyone else? Rocky sir, we are ready.
Yes, sir.
Yeah, please share the presentation slide. Mayank is with us. So welcome, Mayank ji, once again. Most welcome. So thank you
Thank
all
you.
of you for keep patience. Thank you so much.
Yeah. Okay, so I think we have the slides back. Sorry for the interruption. So yeah, let's talk. Like we were discussing call options, right? So the call option is a payout which like has a like uh, the the call option. When you say a call option, it has got two underlying properties. One of it is the expiration date of the option, and the other is the strike of the option. So the call option is unique only given these two things. So you have got expiration date and the strike of the option. So the expiration date, so you have different options trading with different expiry dates. So similar, you could have heard terms like January option, 1 week option, January option, next February option, and so on. So monthly option expiries. So commonly there are weekly and monthly option expiries. And then there are strikes of different strikes. So if you talk about Nifty, you will say that, oh, like I'm willing to buy a 10,000 call option, 10,000 strike call option, 11,000 strike call option, and so on and so forth. So these are the two things. The strike is the price at which you want to lock the asset as of today. So all this is decided as of now, while the payout may depend in future on where the asset price is. So, and the third thing that's commonly known in the option market is the premium. And there's no premium is the same thing as price of the option, is the amount you are willing to spend today to get into that option trade. Right. So the owner of the option pays a upfront premium to the seller of the option, and immaterial of whether the option is exercised or not exercised, that the premium is lost. It's like paying a premium on the insurance. Whether you claim the insurance or not claim the insurance benefit, your premium is the amount you have already spent on buying that insurance itself. Right. The good part about option buyers is that if you're a buyer of an option, the downside or the maximum loss is limited to the purchase price or the premium of the option itself. So like it's like buying an insurance policy. If you may lose out on whatever premium you are paying in case of your option like insurance expires worthless and you never end up using that insurance. Right. So if the underlying option does not rise above the option strike price prior to the option expiration date, then the investor loses that amount of money, which is the premium that he has paid upfront on this option. Right. With that, can we move on to the next slide, please? Which is like, okay, so there are two common types of option, which is the call option and the put option. So we are discussing call options in here. So let's talk about call options in using a particular example, right? So let's say a stock options. So in case of the call option is always on a certain like amount of underlying stock. So let's say one option means 100 stocks in this case. In Nifty, I think the common terminology is one Nifty option means underlying stock of 75 lots of underlying Nifty index. Similarly, in this example, we are saying that buying an option means that you can exercise the option to buy 100 shares of underlying stock, right? So assuming in this example that a trader or an investor buys this call option of this stock with a strike price of $25, right? He ends up paying $150 for the option. So in $150, he's buying an optionality to buy this stock at a future point at $25 per stock price. So if it is 100 shares, he's willing to buy. He's getting into the option to buy 100 shares with each share at $25 per share. Right. So on the expiration, like let's take a practical example of what happens on the expiration date. Let's say on the expiration date of this the stock is trading at $35, right? So then the buyer will say that, okay, I have an option, I have a contract which allows me to buy the same stock at $25, right? So he's being a rational investor. He's going to say that I'm going to exercise that option and I am going to buy that option at $25 per option. So he's going to buy 100 shares at $25 per share. And as soon as he buys this share, since the share is trading at 35 or the stock is trading at $35 in the market, he can use that option to buy those 100 shares and sell them right away if he wants. And the selling price he will get is $35 per stock. So he'll end up pocketing $3,500 from the sale, where he's on exercising the option. He exercised it at $25 per share. So he nets a profit of $10 per share. And in this case, the option was linked to 100 shares. So the overall profit in this case he has is $1,000. Of this $1,000, remember, he spent $150 in order to buy this premium itself. So the net profit is $850 in this case, where it's just the $1,000 minus the $150 of premium that he paid on the option, right? And what happens in this case if let's say that the a stock price was below $25 a share. Let's take an example where it was $20 per share, right, on the expiration date. In this case, he will not exercise the option because there is no point of buying something that is trading at $20 to buy it at $25 by exercising that option. So in this case, he will leave the option unexercised and will not be, so in that case he will incur a loss of $150 because he paid that $150 of premium for buying that stock or for buying that option, right? So with that, let's move on to the next slide, please. So now this is what we looked at from the buyer's perspective of buying the call option, right? Now let's look at the symmetrically from the seller's perspective. So from the seller's perspective, what has happened is that okay, so in this case the stock could have been like trading at like $10,000 per share, and so in this case the seller would have unlimited loss, right? Or potentially unlimited in the sense that he can incur a very large loss if you're an option seller. That's why people say that selling options is a risky strategy, much more riskier than buying options. But because if you're selling an option, you are if the stock moves against you, you can potentially have a very large loss, right? So incurs a loss equal to the and it's a symmetric. The option, the seller's loss is equal to buyer's profit. So as you can see, the buyers has unlimited gain while the sellers has unlimited loss, right? So in the example portrayed below, with an option premium and the strike price of $100, $10 loss. If so let's take the similar example where you are selling a option at a strike price of $100 and spending a premium of $10. So like in this case, you're not spending, but the seller is earning a premium. Similarly, right? So he's earning a premium of $10. He's selling it at a strike price of $100. And in this case, the buyer, if the stock on the final expiration date, if the asset or the stock is trading at less than $100 per share, then the buyer will you do not exercise that option, and seller gets to keep or pocket that premium that has been paid, which is $10. However, if kind of the option is or the underlying stock is trading at a higher price than $100 per share, then the option buyer will exercise that option, and seller can incur a lot of loss depending on where the underlying option where the underlying stock is trading at that point of time, multiplied by the amount of shares that is linked to the underlying option, right? So this is like seeing it from so from a practical perspective. Let's talk and think about. So like it sounds like everyone should be buying options. Nobody should be selling options, right? It's the same thing. Like if buying an insurance is so cheap, so has a limited loss. Why doesn't everyone buy insurance? Why are there option like insurance sellers out there? Because again, to naively see it in payout terms is not enough. You have to see it in terms of the probability of that event happening as well, right? So think of it as that if you're selling an option of $10 per stock, and the chances or the probability of you ending up in the money or exercising that option is very small, then in most cases I want to sell that option and pocket the $10 per this thing, although I'm exposed to a very large loss, but the probability of that loss happening is a very, very small amount. So it's not enough to just see it from an angle of, oh, what is my potential upside, what is my potential downside, and decide to buy and sell based on that. Like you have to use proper mathematical models to judge what is not just like what is the probability of such an event happening, or what is the chances of it happening. And people use a lot of complicated mathematical models to predict or to kind of understand what option at what prices should be. So it's a very tight market. It's a fairly competitive market. So people use a lot of sophisticated techniques to kind of figure out where, like, at what price you should be buying or selling these options at, kind of. And in fact, as it turns out, in the again in a law of large numbers, the option buyers are the ones who kind of options, like, it's more profitable to sell the options, but it can be much more risky. So it's a risk reward ratio thing that comes with it. So option buyers have a lot of potential upside, but on an average, they make much less money than option sellers do. But and it's a similar concept in finance and in general in life, that if the higher the risk, the higher the reward. So option sellers have much higher risk, and so they expect a much higher reward for the risk that they are taking. Right. So with that, we come to the next slide, which is like, okay, so till now I was talking abstract terms. Let's think of in terms of proper mathematical graph, right? So in this case, we had like the current stock price. The x-axis is the share price of the option at the expiration date, right? And the y-axis is the profit or loss depending on where the share price is. So the example we are taking is the last example. I'll reiterate what the example is. That the strike of the option is $100, right? And the premium that is spent is $10. Okay, so $100 is the strike, $10 is the premium to buy that option. Let's think of it in terms of buyer's perspective, right? So if it goes to $200, right? So the amount of profit that the buyer makes is he can buy that stock, something that is worth $200 at a cost of only $100, net taking a profit of $100 in there. Of that profit of $100, he has spent $10 on buying that option itself. So his net profit is $90. So if you look at the black line in there, that is option buyer's profit. So what is the break-even point? Break-even is described at where there is no profit, zero profit, right? In order to achieve that break-even point, he needs to pocket $10 at the expiration of the option, because he needs to break even on the amount he has spent on the option, on buying the option itself. So in order to pocket that $10 in the premium, he needs the stock price to be at least $110. Right? So so if you can see, like, it's a linearly increasing y is equal to x line beyond $100, because as you go further and further away from $100, the more farther you are on the $100, the more profit you are making. Right? If it is $500, you're making $400 of profit, because you're buying something at which is worth $500 at only $100. So that is the black line that is representing, right? And why is that below zero? Because that is the $10 premium you have spent. So it, like, since so that's what we were discussing, that the downside of the option buyer is limited to the amount spent in the premium. So if the stock price ends up below $100, then all you have done is you will not exercise the option and you will let the premium go waste. Right? So if the stock price is below $100, you will see a constant loss of $10 minus $10 in that case. Right? And from $100 to $110 is where it kind of, you start to get hitting your break-even point. 110 is where the break-even happens, because the $10 you have spent, and so if the stock price is $110, then you have pocketed $10 at the expiration of the option, and your profit increases linearly beyond that point. So the black line represents the payout or the profit from the option buyer perspective. And from an option seller perspective, we discussed is whatever, like, one man's gain is another man's loss, as it in terms of pure payout terms. So the option writer will pocket a premium of $10 if the stock price remains below $100, and as it starts to get more than $100, it starts to decrease and linearly go beyond zero. So in terms of mathematical payout, it looks like a hockey stick payout, because it's from a buyer perspective, it's constant loss up till a certain point and then a linear profit. From a seller perspective, it looks like an inverse hockey stick. which is like a constant profit up till a point and a constant and a potential downside, a large loss in the downside. So if you, as you can say, when we say that option writer has an unlimited downside risk, because you can see that this orange line can go much below zero if the share price explodes, kind of, right? So this is called the call option, right? With that, we move on to the next slide, please. So now what is, so we discussed call option, and we've gone in quite detail on what the call option means. So now let's describe what a put option is. So the put option is very similar to a call option, apart from the fact that you own the right of not buying that share but selling that share, right? So what does it mean? So let's say, let's take an example of example of a practical example. Suppose you are a big farmer and who's producing wheat, right? So you know that you, what, like, as a farmer, you have a guess estimate of what your production is going to be in 2 years time. Now you're worried that, okay, my production cost is a certain amount that I probably can project, depending on various cost, various items. But I am constantly worried that, oh, I don't know where the wheat is going to trade from 2 years from now, and how much am I going to kind of earn by selling that wheat from 2 years from now, right? So that is called, so in order to get that, a farmer would love to get into a position where he can decide today how much, at least, at the very least, how much can he sell this wheat by in 2 years time, right? So in order to do that, the common terminology in financial markets, it's called as, he will go and buy a put option. As the name suggests, put means give. So at that particular point in future time, he will be able to sell that option for a pre-specified level or strike price that is determined as of today, right? So again, getting back to the same example which we were discussing. So the put option gives the buyer the right to sell. Again, it is a right, not an obligation, to sell the underlying asset at a pre-decided strike price that is decided as of today. And again, the profit or the loss that the buyer makes depends on the spot price or the price of the underlying commodity, which is, or the commodity price at the option's expiration date or at a future point of time, which so if the spot, so let's again take an example of this. If the spot price remains higher than, at the final expiration date, is higher than the strike price. So strike price is nothing but a price at which you agree to sell the payout right now. Sorry, the strike price is the price at which you agree to sell this option or agree to sell this underlying asset at a future point of time. If the actual price of the option is higher than the strike price, then you will not exercise that option, because you can sell it into the market at already in a higher prevalent. The prevalent price is a higher price than what this contractual obligation or contractual right has. So you will not exercise that put option. However, in, like, let's take an example, again, the same example of the farmer's example we took. If the price is less than, if the wheat is trading at a much higher price than what the farmer predicted it to be, he is going to sell the wheat, and he will not exercise this option. He is going to sell the wheat at whatever price that is prevalent in the market as of that point of time. However, if the price of the wheat is less than the strike price of the option or the put price of the option, then he will exercise that option, and he will say that, okay, I have a contract that allows me to sell it at a higher price than the price of which is prevalent in the market, right? So in mathematical terms, let's look at the same example, right? As a seller, let's say you take $100 stock, you buy it, you buy an option to exercise the stock at $100, and you spend $10 as a premium on that, right? So the black line represents the profit from a buyer perspective. The orange line represents the profit and loss from a seller perspective. From a buyer perspective, if the stock price is trading at more than $100, then you will not exercise that option, because you will, why would you sell something that you can sell at a higher price at $100, right? So you will say that, okay, I will leave that option unexercised, or I will leave it expire worthless, and I will going to only expire the like I'm let it go like expire the option worthless, and I would have incurred a loss of the premium that I have spent of $10. So that's why you see the black line beyond $100 is a fixed limited loss of $10 or minus 10 at minus 10. And similarly, if the stock price is lower and lower and lower than 100, the more lower you get, the more higher the profit for an underlying seller. Because let's say the stock price is currently trading at $10, what he can do is he can sell it for $100 using this contract. So basically, he can buy the option from the market at $10, sell it at $100, and pocket the $90 as the premium, as the profit at the payout, as the final payout, right? So I hope it's clear. So it's a very simple example. And again, the seller, from an angle of seller, it is a symmetric payout as from the from the buyer's angle. Like it's completely, so whatever is the black line, the orange line is just an inverse of the black line. So as the buyer makes more profit, the writer makes less profit, and so on. So in this case, again, the buyer is the one who has limited downside of $10 of the premium he has spent. The writer has a limited upside of $10, but a potential much larger downside, right? So again, very easy to understand, simple concept. Buyer limited downside, seller unlimited downside. Buyer pays the premium, seller receives the premium. Call option is an option to buy, put option as an option to sell, right? It's as simple as that. That's it. So with that, let's move on to the next slide, please. So yeah, so let's go into a more detailed interaction. So this is like, okay, so we discussed what the final payout is, right? At the expiration date. Now with the previous plot, it was very clear, which is the yellow orange line from a call option perspective, what the payout of that option will look like, which is a hockey stick. I remember like the hockey stick payout. If the option price of the spot S of T is nothing but the x-axis in here is nothing but the price of the stock at a future price of the stock, or the underlying asset, or any other commodity on which the option is linked to, right? So the future profit is stock price. The orange line is what is my payout at final point of time, right? Which is like, if the strike price is greater than K is the strike price. So if my stock price or the future asset price is greater than the strike price, then I have a linear payout. I the more the 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 greater it is by that amount, like the amount by which the stock price is greater than the strike price, that is my profit. And similarly, the loss, which is the orange line beyond that strike price, is like the final expiration date is worthless, so it's zero. In fact, I have not, in this plot does not include the premium spent. All the premium spent is going to do is shift the payout by lower than zero by that certain premium, like amount of premium spent, right? So but what happens at the option expiration? But the same option is trading as of today in the, like, right? So what is the price at which I should buy or sell this option, right? That depends on two factors. That depends on, so one is called the intrinsic value. The intrinsic value is nothing but, like, let's think about the payout of this option, or what is the price this option should trade at a time which is smaller than capital T in this case, which is like, let's say the option is supposed to expire 1 month from now. Where should this option be trading right now, right? So with the intrinsic value, we call it, the intrinsic value is nothing but, let's say the things remain here on the expiration date. So you move forward in time, the stock price is what it is right now. So the value of the call option is, as of it was exercised today, is the intrinsic value, which is nothing but the current stock price minus the strike price. And if the current stock price is greater than the strike price, otherwise it is zero, right? The hockey stick payoff. So the intrinsic value is nothing but the hockey stick, or the orange line in the plot below, right? But option price is the market price of the option, which is the black line. And usually what happens is, uh, the the market price is more than the intrinsic value, because there is still time to optionality left. And while it's not very clear why the time value should be always positive, but like it comes from like mathematical models that no matter, because the holder is holding the option is always worth some money, so the time value is always greater than zero. If you look at this, and the farther what will happen is, the farther the option is from the expiration date, the more is the time value, because there is more time to expire. There's more chances that the price will work in buyer's favor, because there's more time left to the option expiration date, right? So always remember, the total price, the net price, which is trading as of today, which is the black line in this plot, is a function of two things. One is the intrinsic value, which is easy to calculate, where you don't need any future prediction, we don't need any modeling, and which is the orange line. And the other line, which is hard to predict, which kind of, there's a lot of math goes around that, is called the time value, or how much should I pay on top of my intrinsic value to sell or buy this option as of now, or how much should I receive on top of this intrinsic value to sell this option as of today, right? So with that, next slide, we move on to the next slide. And again, this is more terminologies than anything else. Is let's say, what are the in the money, out of the money, at the money options? I think anybody who's traded options will be quite familiar with this concept. So the in the money value, again, we describe intrinsic value as maximum, like more mathematically representing it is maximum of the stock price minus the strike price, comma, zero, right? Maximum of stock price minus strike price. And basically, if the stock price is greater than the strike price, then the value is stock price minus strike price. And if it is less than zero, then the value is zero, right? So in the money options is option with positive intrinsic value. So call options whose strike. So what are in the money option? Basically, call options whose, so in the money option is that I stand to have a positive payout if I exercise the option today, right? So in case of call options, it will be if the spot price or the stock price is current stock price is greater than the strike price, is called in the money options. In case of puts, the in the money option, since I'm selling that option, is where the strike price is greater than the current price of the underlying stock. So again, it's symmetric. Call option, the strike price in the money means if I exercise the option right now, I am in the money. I get some money out of it, right? So how do I get some money out of it? Only if the current stock price is greater than the strike price. And similarly, in put options, how do I get like, how do I, in case of put options, what is the in the money option? Because I'm selling that option at a strike price, my current price of the underlying stock is less than the strike price. Then because the current strike, so in that case, I am able to sell that option at a higher price than it is prevalent in the market right now, right? So this is called in the money options. Out of the money options is symmetric, the opposite way around. So out of the money option, as the name suggests, means that if I exercise the option right now, I don't end up with zero profit. And because when does it happen? It happens in case of call options, and the call option is less than the call option price is less than the strike price. In case of put options, the strike price in case of call options, the strike price is greater than the current price of the underlying stock. In this case, it will be out of the money option, because let's say the strike price is 100 and the option is trading at 90 or $80 per $80 currently, then there is no point of exercising that option, because the intrinsic value in this option is zero, right? So that's why it's called out of the money option. If I exercise it now, I don't end up with any money, right? And similarly, it's symmetric the other way around for put options, where strike price is less than the current price of the underlying stock. What does it mean? That if the strike price is $100, I am out of the money if the put option is if the current price of the stock price is So yeah, if I'm out of the money, if the current stock price uh, is is greater than the current stock price is greater than the sorry, the current price of the underlying stock is greater than the strike price, or the other way around, a strike price is less than the current price of the underlying stock. And at the money option is nothing but the where the strike price is the same thing as the current price of the underlying stock. So in this case, it's the boundary between which the option switches from out of the money to in the money, or the other way around, from in the money to out of the money. So again, let's take the example in this sheet. So if I have a call option, my strike price is 45, my stock price is $40. It is an out of the money option by the rules I specified, right? Similarly, if the strike price is equal to stock price, it becomes at the money option. If the strike price is less than the stock price, then it becomes in the money options. So, and symmetrically for the put case, if the strike price is 80, stock price is 100, it is out of the money. If the strike price is equal to stock price, then it becomes at the money. And if strike price is greater than the stock price, it becomes in the money option. So these are the common terminology, whether the option is in the money, out of the money, or at the money option. Again, referring back to the previous slide, the in the money options means that a strike price is less than the stock price. But even in the money options, sorry, out of the money options, don't trade at zero price, because there's always a time value associated with it. So the intrinsic value is zero, the time value is not zero. So, and why is the time value not zero? Because there is a probability that the stock price may move in your favor from now till the expiration date of the underlying option, and hence you do not want to. So it's like the same thing. Like if you're not claiming an insurance today, if the current conditions do not allow you to claim, like you go and buy a car insurance, if your car is in a healthy state today, doesn't mean that you're going to sell that insurance at zero, right? It probably, there is a chance in future from the current price of buying that insurance to the expiration date of the insurance that you might need that insurance. So hence a seller will not sell it at zero premium. The intrinsic value is what happens if you exercise the option now, but then there is time value associated with it, is that due to the future unpredictability, what can happen in future so your total premium depends on both these factors, the intrinsic value as well as the time value in case of options, right? Let's move on to the next slide, please. Right. So the another form of common types of options are American versus European options. Again, the name doesn't reveal what they mean. The name is just confusing. They have nothing to do with options trading in America versus options trading in Europe. It just means altogether something different things. So the American option and the European option is, so the European style options is something which can be exercised only at the expiration date of the option. The American style option can be exercised either on the expiration date or any time prior to the expiration date. So if the option expires in, let's say, 1 month, then if you're a holder of a European style option, then you have to wait 1 month to exercise that option. If you're a holder of American style option, you can exercise that option anytime from now till the expiration date of the option itself. So it's clear that American option is European option plus some other optionality on top of being able to exercise it early enough, having the right to early exercise as well. So by, like, it's simple to think that American option should have higher premium because somebody is giving you higher optionality and he will charge up for it. So American options have extra optionality to exercise that option earlier than the expiration date. So the price of American option should usually be higher, or at least the same as the European option, with the exact same underlying strike or underlying expiration date, right? Again, the next point is more mathematical. I would not try to kind of diverge into too much of this. It requires a lot of lot of experience of modeling these things, but in general, what happens is early exercise doesn't come with too much premium associated in most of the in most cases. So usually American options and European options trade at a very similar price, because like intuitively you can think of it as that, right? The time value, if you're exercising it early, you're giving away the time value away. So the time value is always positive. So there is no point of, almost in normal market conditions, there is no point of early exercise. It is true that early exercise matters in certain cases where there are dividends and other things to be paid from right now till the option expiration date. So if you exercise early, you don't earn the dividend, or if you wait for the option to exercise, you will earn the dividend on the underlying stock, right? In like in India, most of the options that are traded on bank nifty and underlying stock options are usually European in nature. So they kind of have, you can only exercise them at the final expiration date, and in fact you don't even have to manually exercise them. The exchange will determine where the price of the underlying future is and will auto exercise it for you. So you will, they are called cash settled options, in the sense that the exchange will exercise it for you, take the difference of what your profit was, and directly put it in your account as the settlement value. So you don't even have to decide, oh, I want to exercise this option or I don't want to exercise this option. Even if you don't give that statement to your broker, he will automatically exercise it based on what he thinks will be rational for you to exercise it. If the strike price is greater than the option price, then he will exercise. Otherwise, he will leave the option unexercised. Right? So with that, we move on to the next slide. Right. So again, let's do the case study again, because again, it's simple. So I think I won't spend too much time into. We have already discussed this. Is that okay? The payout of the call option is a hockey stick with a premium downwards. The payout of the put option is an inverse hockey stick with kind of or call option writer is the inverse hockey stick, the orange line, as described in here. So like, let's see the strike. Like again, this example is discussed in detail with different values of what the future stock price is. So assuming that the strike price is $10, the premium you spend is $1. Like in future, if the strike price is if the spot price is like depending on whether the spot price is $8, $9, $10, $11, or $12, what your profit and what your loss is, and whether you exercise the option or not exercise the option, right? So the, as you can see, the loss is only limited to the premium spent upfront, which is $1, while the profit can increase. The table does not show values below $12, but if you go below $12, you will see that the profit keeps increasing while the loss is limited to $1. And below the strike price, you are not exercising the option. Above the strike price, you're definitely exercising the option. At the strike price, it doesn't matter. It's the same thing whether you exercise it or not exercise it. It really doesn't matter. It's your choice, kind of, but it doesn't change your payout. Similarly, from a call writer perspective, you will see that the inverse payout, again, this is nothing but, you can look at the graph below, and the x-axis is S of t and the y-axis is the profit, and you can just say that pick up the x-axis and y-axis and the values against it, and that's what we have done. And the exercise is decided based on whether the call option is in the money or out of the money, depending on and if the call option strike is same as the option price is same as the strike, then there is no in the money or out of the then it's irrelevant whether you exercise or not exercise the option. So with that, we move on to the next slide. Again, this is a similar time value explained in a little bit more detail. So the gray line in there is the intrinsic value, right? The red line and the blue line are time are the option prices or the option premiums with different expiry dates. One is with, let's say, 5 days left to expiry. The other is only 1 day left to expiry. Again, it is very clear 5 days means more time value, right? It's farther away from expiry. So the blue line will trade at a higher price than the red line in there. And both these lines, and the black line the gray line can be considered as another option with 0 time value left, or expiry is equal to 0 day, right? So the more, so what this plot, what I want you to understand from this plot is, the greater the time, the expiration date, the farther the option is from expiration, the more is the time value associated with it. That's why the blue line is always above the red line, because there is more chances. There are 5 days left for the market to move in your favor, or for the underlying stock price to move in your favor, than the orange red line, where there is only 1 day left for the option or the exercise option to move in your favor, right? With that, we move on to the next slide, and let's try to read this. Sorry, I don't know whether this is like visible or not, but this is the diagram. This is the chart I just picked up from the Nifty website, and let me quickly describe what these different columns mean, so that people who are who are just seeing it for the first time can kind of understand what this terminology means, right? So on the center of this thing, you will see a strike price, and this table is for one particular expiration date. In which case, I picked up like maybe December end expiration option expirations. So for each option expirations, different rows denote different strike prices. So starting from 8100 going down to I think 9600 are different strike prices, right? And the current Nifty index when this was picked up was close to 9,000. So at 9,000 level is, so you see the yellow part of these things. So on the right I put options, on the left are call options. There is section which is highlighted in yellow. There's another section which is in white. The yellow background options are out of the money options. The other way around. Yeah. So the yellow options are sorry, in the money options, because its strike price is less than the current spot price, which is 9,000 right now. And then similarly, the put options, the yellow options are again in the money options, because the strike price is greater than the current prevalent price of the Nifty index, which is around 9,000, right? And let's quickly go over what these columns represent. So OI stands for open interest. Open interest is nothing but number of outstanding options. So every time you buy, someone buys and sells our option, a new option is entered into this chart, and this is called the open interest. So the higher the open interest, the larger the number of outstanding options are, right? Change in open interest is how many new options got issued on that particular day, on that trading date. So that is called change in OI, is change in open interest. Volume is amount of options that are traded during the day. So what's the difference between open interest and volume is that, suppose open interest is only going to increase when I uniquely issue a new option, or when somebody uniquely issues a new option. So suppose I I'm an owner of a call option, I sell it to another person who is not the writer of the option, then the volume gets increased by 1, because there's one option that got traded, but the open interest remains unchanged. So the volume represents the amount of options that got traded on that particular day, right? The IV represents the intrinsic value of, IV represents the implied volatility. Again, this is a more complicated topic. I will not get into detail, but pricing the option is basically trading options is trading implied volatility. And then the net change, and then you have certain columns showing that bid price. So bid price and ask prices. So the market maker in this case is willing to buy that option and sell that option at different prices, basically. So the bid price and bid price represents at what price is he willing to buy that option, and at what price is he willing to sell that option. And the bid quantity and the ask quantity there represents what is the size he's showing to the rest of the market. So it's like NFT is an order book. So on the order book, you will have market makers putting orders in there, saying that, okay, I am willing to buy these many options at this price, and I'm willing to sell these many options at this particular price. And the difference, you will always see that the bid price is less than this ask price, and the difference between the two price is market makers commission, or market makers it's not profit, because again, it's like he's in the business of buying and selling houses. He will have an inventory. if depending on whether inventory moves. So he already so by constantly so the market makers are always willing to make both-sided market. He's willing to sell to every buyer. They're willing to buy from every seller, but they are willing to do it at different prices, and they're willing to maintain and they carry as a like you will not always find a buyer for a seller at the same amount of time. So you will always end up with inventory on one side or the other, and the market may move in favor of you or against you depending on your inventory size. So the difference between bid and ask price is usually the amount of commission they want to keep for themselves in order for the risk that they are taking, or in order for the service they are providing for making two-way market on that. Right, the same chart represents the same thing for the put options on the right hand side, and kind of as you can see these like there's a pattern in there. I'll not go into too much details on what the prices represent and how to that requires a more like much a longer session on how these prices are computed, and how do I determine whether the option is cheap or expensive, and so on and so forth in that case. Right, so this is the Nifty options chain. Coming out to the last two slides in there. So kind of right. So coming up onto the next slide, which is about covered calls versus naked calls. Again, I think I've got into too many technical details, so I'll rather like skip these slides. Like I'll just briefly summarize these slides, and I'm happy to answer questions if there are anyone on them. But a naked call and a covered call, the difference is between this. A short call or a naked call is something that if you're writing an option and you don't hold the stock against it. So it's called naked call selling in the sense that it has got unlimited downside. However, if you own the stock and then sell a call option, if the call buyer exercises that option, you already have a stock in your inventory to deliver that option. So in this case, your downside is limited by the fact that it is you already hold a stock against that particular option you are selling. So in other words, naked call is a much riskier investment strategy than a covered call, because the covered call, you have the stock in your pocket. If the stock moves much higher in price than the amount you lose on the option you would have made in the stock you own, so you've suddenly converted an unlimited downside instrument into a limited downside instrument by selling it as a covered call instead of a naked call. Right. So coming back to that last slide again, the plots represents what these naked calls and what this payoff is. But again, it's very similar. If you understand the concepts, it is very easy to derive the plots. Kind of, it's not hard. Right. Coming back to the different option trading. Next slide, please. Yeah, the different options trading strategies. Right. So again, these are so the beauty of this is you can combine different options to come up with payouts that don't look like hockey stick but much more complex than a hockey stick, and depending on your investor appetite or your risk appetite or your view on the market, you can end up customizing your payoff. So all you are doing is combining different options to create a payoff which looks any of this one below and in the charts denominated on the right hand side. And again, it's not rocket science. It's as simple as you take multiple options at different strikes, combine them to kind of fill the to convert a payout. On the payout you need the option option payout to be. So again, very broadly I've described a few payouts in this. So let's say a straddle is nothing but a common payout is straddle, which is saying that I buy a call option, I buy a put option, I buy both the options simultaneously. So if the market, I would buy that option if my view on the market is that the market is going to move. I don't know which direction is it going to move. It can go up, it can go down, but I am pretty sure it's going to move one way or the other. Right. So in order to get into such this thing, what I do is I buy the call option as well as I buy the put option. Of course, I spend more premium in the straddle, but if it moves in either direction, if the stock price goes higher, then my call option makes money. If the spot price goes lower, then my put option makes money. So if you look at the long straddle payout, which is like on the right side with the third column, third row, first column, you see that on both sides I'm making large potential upside profit, but I have spent a premium. Hence, I need, in order to reach my break even point, a break even point of no profit, no loss, I want the underlying stock to move by a certain amount at which the break even point is attained, right? On the other side, if I am sure that the market will not move too much and will remain here at the current level, I will sell a straddle. In which case, rather than collecting an option premium from call option, I will collect an option premium from both call option and from put option both, right? The strangle is exactly same as straddle, but with not at the money call options, at the money call and put options sold, but out of the money call and put options sold. So the premium you earn is less than the straddle premium, but you have to give yourself a higher range for to be in profit, right? So these can get more complex. This is just a high level introduction of, if you hear these terms, you kind of can understand what they're supposed to mean by doing a little bit of refiguring out and redoing this research. Right. So, and the last thing is what is the option? So why do people trade options? What is the risk? What is the reward? And kind of what is the benefits and losses of trading in options, right? So one of the most common people, like everyone wants to trade options these days, is because they want to get exposed to the leverage. But leverage is risky. You want to do it only if you're sure about it, or you want to take a higher risk. All the leverage allows you to do is take a higher risk. So in order to, instead of buying the option and committing a large amount of capital on instead of buying the underlying stock and committing a large amount of capital to buy the underlying stock, you want to buy the option because you get more payout out of that option for the same amount of investment you make. But again, this works both ways. So it can give you a higher reward, but it can give you a much higher upside, but it comes with a much higher downside as well. So should treat it with caution. Like, leverage is fine as long as you understand what you're doing. And if you're an option, if you want to play it safe, option buyer is playing it more safe, because your limit is losses. You limit your losses to the premium you paid. Like, it's like buying an insurance. If you say that, okay, the amount of insurance premium is, you're willing to say that I'm okay to lose on the option premium, then for sure, buying an option seems like a better strategy. But the problem with option buyers is the premium can go worthless if the asset price does not move in your favor. Same as the insurance can go worthless if you don't need that insurance, kind of, right? Right. And one of the most common things people underestimate about options is options have an expiration date. So even though you think that the market will going to move in your favor, or you buy a call option thinking that the market is going to go up, it might only go up after your option expires. So the option expiration is an important consideration to take. You buy a 1 month option and the market does not move within 1 month and moves after 1 month, even though you are right, you don't get paid anything for it, because the option has already expired, right? And it's true, like option buying and selling trading, it's more common. Option selling is risky, same as selling insurance, right? Insurance sellers is a risky strategy, but kind of people do it with higher risk comes higher reward. So on expectation, and on expectation, I really mean on average, option sellers make more money. But again, you can have a big loss, as selling options. So be careful. Understand what your limited losses are. Like, option selling, though, ends up usually making more money, it comes with a much larger potential downside. So kind of, I've seen people trading options who have who are in the business of selling options, who have made profits of through multiple months, and suddenly they lose all that money they have made, because option selling is risky, much more risky than option buying. Cool. So with this, the last slide on kind of what is the factors that kind of influence the price of the option, right? So as we've discussed some of these factors in detail, right? Clearly the price of the option depends on two things: where the strike price is and where the stock price is, right? So the price of the underlying security in relation with the strike price, right? The second thing we discussed about time value of options is the time to expiration. The more time to expiration, the more time value in it, the more expensive the option is going to be, right? And also, like when you're buying or selling an option, you're committing some capital. So depending on how much, so let's say option is like how much, what can you do with that capital? You can invest it in somewhere else, earn interest. You can invest it in a fixed deposit and earn interest rate on that, or fixed interest on that. So it comes at the cumulative cost of how much capital you're investing and what is the cost of that capital you're investing. And one of the most important feature of option volatility, option trading is what is the future volatility of the security price. The future volatility comes with kind of, it's one of the least known factor, and that's where most of the prediction happens. And note that the price of the option is like, it's the beauty of options is really when you are dynamically managing it, risk managing it, is that option you can buy, the market can move. So if you're dynamically managing it, and that's what most of these market makers do, they don't take a view on. So when people, like I've been trading options for 10 years, and when people come and ask me, oh, the market is going to go up and down, I don't know whether the market is going to go up and down. I am making a prediction on how volatile the market is going to be. And there is some mathematical models or strategies that say that, okay, as long as the volatility is limited, I will make money even the market goes up or goes down, because I am hedged to the price moments of the underlying stock. And this model is pretty popular in financial community, called the Black-Scholes-Merton model. And it's that popular that they won it was a paper that was published in 1973, which ended up in a Nobel Prize, because it is really the gold standard for option pricing across the board in across the board in different like in almost all the communities in there. So yeah. So when people talk in terms of options, people, you've commonly heard, if your option trading is, oh, what is the implied volatility, or what is, and in these days it's called VIX, VIX, right? What is the VIX index? The higher the VIX index, the higher the implied volatility. And especially post-COVID times, when the market is moving around a lot, the VIX is higher. The VIX higher means that the premiums have gone up, because the market's upside and the downside potential has gone up much more. So the VIX is the indicator of what is the call option premium or what is the put option premium trading in the market, kind of. Right. So with that, I think I have covered whatever I had to cover, and I'm happy to answer any questions or any other comments if you have.
Participants, if you have any questions, you can go ahead with them.
Cool. Like I hope this was useful. So again, I know it is a little bit more dry than this usual stuff. It doesn't it contains a little bit more mathematics, but I hope that you find it useful and learn something about, like they're getting more and more popular these days. Everybody wants to trade options without people understanding what they mean. So the purpose of this presentation was trying to educate you a little bit more about what when people say all these jargons, at least you have you associate with it a bit more than you were able to associate it before this presentation, kind of. Cool. So sorry.
Okay. Thank you, sir, for a knowledgeable and simplified session. And since there are no questions from any of the participants, I would thank from the side of the institution to you. And then we would break for the lunch break. We'll be joining the second session at 1 o'clock.
Cool.
Thank you, sir.
Okay. Thank you. Thanks a lot for having me. Bye. Take care.
Thank you, sir. So the next session would be at 1 o'clock, and the next guest in the session is Dr. Shailendra Dubey from Ministry of External Affairs, New Delhi. And till then, have lunch, enjoy. And I hope everyone has filled the feedback form for the first session. If not, kindly do so.